Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind the official filings that shape the business world. This time, we're diving deep into a report that shows how one of the big players in finance, OMF Holdings Incorporated and Ohm Finance Corporation, were doing up to September 2025. Think of it as a financial checkup with some interesting surprises, and remember to join our Discord community linked in the description below, where we chat about these filings and much more. You will not want to miss out on the juicy details we found. So, what is this report all about? It's a quarterly update, a 10Q filing, giving us a snapshot of the company's financial health and operations. It covers the period ending the 30th of September 2025. Basically, it tells us how much money they made, how much they spent, and what their financial situation looks like right now. Let us get a handle on the size of these companies. OneMain's Holdings Incorporated had over 117 million shares of its stock out there as of the 24th of October 2025. And for OneMain's Finance Corporation, another entity in the mix, there were just over 10 million shares. This gives you an idea of the scale we are dealing with. Before we get into the numbers, it is always smart to quickly look at the glossary. They explain what all the abbreviations and special terms mean. For example, they define terms like net finance receivables, which is basically the money customers owe them after accounting for things like unearned interest. Understanding these terms helps us make sense of the real financial picture. Now let us crunch some numbers. In these condensed consolidated balance sheets as of the 30th of September 2025, we see total assets standing at a massive $26.9 billion. That is a lot of stuff. On the other side of the coin, liabilities, which is what they owe, were just shy of $23.6 billion. This leaves them with shareholders' equity of about $3.3 billion. It is like looking at a company's net worth report card. Interestingly, they have about $1.6 billion in what they call investment securities. These are investments they hold. And this amount shows they are not just lending money, but also managing other assets. The biggest chunk of their assets by far is net finance receivables, which totaled an enormous $24.4 billion. This is the core of their business, the money customers owe them from loans and credit cards. The fact that this number is so large tells us that lending is where they make their money. Moving on to how they perform, the statements of operations tell the story of their income and expenses. For the 9 months ending the 30th of September 2025, their net income was $579 million. This is up significantly from $383 million in the same period in 2024, which is great news for shareholders. A huge part of their income, $4 billion in the first 9 months of 2025, comes from interest income. This means they are earning a lot of money from the interest charged on their loans. But of course, they also have to pay interest on the money they borrow to lend out. Their interest expense was $949 million for the same period. So their net interest income after paying for interest expenses is a cool $3 billion. That is where the profit really starts to build. Now, here is a crucial part, the provision for finance receivable losses. This is money set aside to cover loans that might not get paid back. For the first 9 months of 2025, this was $1.4 billion. While it went down a bit from $1.5 billion in 2024, it is still a massive number that shows the inherent risk in their business. And for the shareholders, the diluted earnings per S-share was $4.84 for the first 9 months of 2025. This represents a solid increase from $3.18 in the same period last year. This means the company is becoming more profitable, and each share is effectively worth more. Let's dig into those finance receivables a bit more. Their personal loans, which are secured by cars or other items, or sometimes unsecured, total $21.2 billion in net finance receivables by late September 2025. That is a lot of money lent out to individuals. Then there is auto finance, where they provide loans for car purchases. This segment accounted for $2.4 billion. It is smaller than personal loans, but still a significant part of their business. And finally, credit cards. They have $834 million in net finance receivables for credit cards. It is interesting to see how this has grown from $643 million at the end of 2024, showing an expansion in this area. When we look at credit quality, the gross charge-off ratio, which represents money lost because loans were not repaid, was 9.05% for the first 9 months of 2025. This is slightly down from 9.60% in 2024, indicating a small improvement in their ability to collect on loans. This section on the allowance for finance receivable losses is super important because it shows how they are preparing for potential defaults. They set aside $2.8 billion to cover potential losses. The fact that this allowance increased significantly from $2.6 billion to $2.8 billion from September 2024 to September 25 suggests they are being more cautious. Possibly due to economic uncertainties. Their investment securities, worth about $1.6 billion, mainly consist of corporate debt and mortgage-backed securities. They are holding these investments, but the focus remains on their core lending business. It is worth noting that a good portion of these investments have unrealized losses, meaning their market value is currently less than what they paid, but they are not selling them because they believe they will recover the cost. Now for the debt. Long-term debt totaled a hefty $22.3 billion at the end of September 2025. This is how they fund their massive lending operations. A significant portion of this debt is through securitizations where they bundle loans and sell them to investors. They also issued substantial amounts of unsecured notes throughout 2025, raising billions in funds. For instance, on the 17th of September 2025, they issued $800 million in senior notes. This active debt issuance shows they are constantly managing their funding to support their growth. This is where things can get a little complex. They use what are called variable interest entities, or VIEs. Basically, these are special legal structures they set up to hold assets like loans, so they can finance them more easily. They include the assets and debts of these VIEs in their own financial statements, because they have control over them and are mostly on the hook if things go bad. The total debt from these VIEs alone was over $12 billion. Beyond lending, they also have insurance operations. This includes offering things like credit life and disability insurance. The reserves for unpaid insurance claims were around $99 million. These operations complement their main lending business. For OneMain Holdings Incorporated, the diluted earnings per share was $1.67 for the 3 months ending the 30th of September 2025. This is a noticeable jump from $1.31 in the same period of 2024. Shareholders are seeing better returns on their investments. This section deals with changes in value that are not directly on the income statement, like fluctuations in the value of their investments. The accumulated other comprehensive income was a loss of $47 million at the end of September 2025, which is an improvement from a loss of $59 million at the end of 2024. They are slowly managing these unrealized gains and losses. The amount they pay in income taxes reflects their profitability. For the 9 months ending the 30th of September 2025, they paid $173 million in income taxes, up from $120 million in 2024, which makes sense given their increased earnings. Every company faces legal issues, and it is no different here. They mention that they are involved in various lawsuits, investigations, and legal actions that could potentially result in substantial damages or penalties. While they are fighting these cases, they acknowledge that material losses could happen. This is a common risk for financial institutions. They clearly state that their main business, the consumer and insurance segment, is where all the action is. Everything else is considered other and is much smaller, mainly involving the servicing of loans they no longer originate. This shows a strong focus on their core lending and insurance activities. This part of the report talks about how they value their assets and liabilities when the market value is not easily known. They use different levels in their fair value hierarchy, with level 1 being the most reliable, market quotes, and level 3 being the least reliable, based on their own models and assumptions. Their total assets valued this way clock in at a significant $2.5 billion. Now let us talk about what the company expects for the future. In their forward-looking statements, they warn that things like changes in the economy, interest rates, unemployment, and even natural disasters could significantly impact their actual results. They are being honest about the risks. They describe their business as offering personal loans, auto finance, and credit cards to help customers with daily needs and financial well-being. What is interesting is their broad reach, operating in 47 states and offering services through in-person, online, and phone channels. They really try to be accessible to everyone. In recent developments, they have been busy issuing and redeeming unsecured debt. For instance, in March, June, August, and September 2025, they took on billions in new debt, while also redeeming some of their older, more expensive debt. This suggests active management of their financial structure. They are also expanding their board with new members like Andrew D. McDonald and Christopher A. Holme. Looking at the nuts and bolts of their operations, the company saw a significant jump in interest income, up 10% for the 9 months ending September 2025, showing their lending business is booming, which is excellent. Their net income also grew substantially. Even with the positive growth, the provision for finance receivable losses remains a significant number, over $1.4 billion for the first 9 months. This is a constant reminder of the risks they take in the lending business, especially with the current economic outlook including inflation and interest rate hikes. They are setting aside more money for losses, which is a prudent move. In terms of credit quality, delinquency on their loans, meaning payments being late, is a key metric. Their 30 to 89 days past due ratio for consumer loans was about 3.2%. For credit cards, it was a bit higher at 5.38%. While these numbers are not alarming, they are closely watched to see if they start to creep up. They are also increasing their allowance for finance receivable losses, signaling a more conservative approach to potential defaults, a wise move given the uncertain economic environment. Liquidity, or how much cash they have on hand to meet their obligations, is strong. They have about $2.3 billion in operating cash flow for the first 9 months of 2025, and they are actively managing their debt to ensure they have enough funds. Their credit ratings are a bit lower than investment grade, which means borrowing costs can be higher, but they seem to be managing it well through active refinancing and smart debt management. Their financing activities show they are actively managing their capital structure by issuing debt and repurchasing stock, indicating a dynamic financial strategy aimed at optimizing their capital. They have a $1.1 billion unsecured corporate revolver, which is a line of credit they can draw upon if needed, providing a safety net for their operations. It's interesting to see how their insurance business contributes too, offering optional products that complement their lending services. While not their main source of income, it adds to their overall financial stability. Finally, looking at insider activity, key executives like Douglas H. Shulman and Michael A. Headland have put in place trading plans for their company stock. These are usually put in place to ensure compliance with trading regulations while allowing executives to sell shares over time. So, what is the big picture here? OneMain Holdings Incorporated and OneMain Finance Corporation are navigating a complex financial landscape. Their core lending business is strong, with revenues and net income showing healthy growth. They are actively managing their debt, issuing new notes and repaying old ones to optimize their funding costs. The increase in their allowance for loan losses suggests they are prudently preparing for potential economic headwinds, which is a smart move in today's environment. Their diversified approach, including insurance and credit cards, provides some resilience. However, their credit ratings and the ongoing legal contingencies are risks to keep an eye on. They seem to be steering the ship well, balancing growth with caution. That is our deep dive into OMF Holdings Incorporated and OmFinance Corporation's latest financial report. What are your thoughts on their financial strategy and the current economic climate impacting lenders? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more in-depth analysis of corporate filings. And don't forget to join our Discord community for exclusive content and discussions. Linked in the description. Thanks for tuning in to Corporate Decoder. See you next time.